Accounting and finance. Three core financial statement: income statement, profit and loss, show company performance over a period. Formula: revenue minus expense equal to net income. Balance sheet: a snapshot of financial position at a specific data. Formula: asset equal to liability plus equity. Cash flow statement: track actual cash movements, divide into operating, investing, and financial activity. Liquidity ratios: current ratio equal to current asset divided by current liabilities. Quick ratio: current asset minus inventory divided by current liabilities. Profitability ratios: gross margin equal to revenue minus gross divided by revenue. Net profit margin equal to net income divided by revenue. Efficiency ratios: investor inventory turnover COGS divided by average inventory. Return and asset equal to net income divided by total asset. Return on equity equal to net income divided by shareholder equity. Investment analysis tool: net present value of future cash flow minus initial investment. Positive NPV: investment is likely profitable. IRP: internal rate of return, the discount rate at which NPV equal to 0. Higher IRR than cost of capital equal to good investment. What are the three main financial statement? Income statement, balance sheet, cash flow statement. What does the income statement show? It shows revenue, expenses, and net income over a specific time period. Name one profitability ratio and explain it. Net profit margin: net income divided by revenue, shows how much profit a company keeps from each dollar of sales. What is the purpose of calculating NPV? To assess whether an investment is financially worthwhile by comparing today's value of future cash inflow with the initial cost. You are evaluating a new product line requiring $50,000 investment, expected to return 15,000 annually for 5 years. Discount rate 10%. Step 1: calculate present value of annuity. This equal to 5 PV. NBV minus initial investment equal to 6.8062. Decision: since NPV is positive, you should proceed with the investment. International and national and local economics. Micro versus macroeconomic. Macroeconomic focused on individual consumer firm pricing, supply and demand. Macroeconomic study national global indicator like GDP, inflation, and employment. Gross domestic product measure total market value of goods and service produced. Consumer price index indicate inflation by tracking price changes in a basket of goods. Unemployment rate, the percentage of labor force actively seeking but not finding work. Monetary policy, central bank change interest rate to control inflation, adjust money supply. Fiscal policy involve taxation and government spending to stimulate or cool the economy. Local economic factor affecting business: regional wages, property taxes, zoning laws, infrastructure quality. What is difference between micro and macroeconomic? Micro studies individual market behavior. Macro looks at overall economic performance and policies. What does GDP means? Or measure the total value of goods and services produced in a country. How does a central bank fight inflation? By raising interest rate to reduce spending and borrowing. Name one local economic factor that could affect a business, local tax rates or changes in a minimum wage. Your company imports parts from Europe. The euro rises in value versus your currency effect on the cost. Import cost increase because you need more local currency to buy the same amount of euros. Profit margin shrink if prices can't be raised. Economic strategies hedge currency risk, use forward contracts or currency swaps to lock in exchange rates. Local sourcing, seek supplier in your own currency zone to avoid FX exposure.